it's time when we should discuss the unguaranteed residual value. I have continued with the same example which we took while discussing the guaranteed residual value with few modification in the related terms and conditions. In this example, Y estimated the residual value at the end of lease term as 500,000. P agreed to compensate any downward variation below 400,000. Let's see how Y will account for this transaction. First, Y will compute the lease receivable on day 1. In this table, you can see that both GRV, that is guaranteed residual value, and unguaranteed residual value is included in lease receivable on the assumption that it's fully realizable. At the end of the year, Y revisited the measurement of residual value and found it to be 450,000 at the end of the lease term. That means there is an impairment which needs to be accounted by Y. To quantify this impairment amount, Y need to compute the PV of revised residual value at the end of year 1 and then compare it with the balance of residual value at the end of the year to work out the impairment amount. In this table, PV of revised residual value at the end of year 1 is computed. And in this table, balance of residual value at the end of year 1 and impairment amount is worked out. Let's see the accounting entries also. On day 1, Y will de-recognize the PPE and recognize the lease liability. At year end, it will accrue the interest income which is calculated at 5%, account the lease rent for the first year, and account the impairment on unguaranteed residual value. In both guaranteed and unguaranteed residual value, the remeasurement process will continue during the entire lease period, and any deviation having adverse financial implication need to be accounted for. That is all for the residual value. I hope you understood the concept well. If not, don't worry, do some practice, watch the videos again, and you will definitely succeed.